Hey, what's up guys? So in this video, I'm gonna walk you through one of the best ways to buy a home using 0% down, and then I'm gonna give you some tips on how to minimize your out-of-pocket costs using this type of mortgage. So let's jump into it. Hey, what's up guys? I'm Ben Sund. If you've been here before, welcome back. If this is your first time, welcome for the first time. We don't just talk about mortgages, I also talk about improving our overall financial health through things like personal finance, investing, and real estate. So if you're interested in stuff like that, please hit that big red subscribe button. You know, one of the best parts about getting into video production, if that's what you want to call this, is when you record an entire video and you don't realize that your mic was off the whole time, and then when you go to edit it, you realize that you have no sound, and so now you have to re-record the entire video. But we're gonna move past that, and we're gonna talk about one of the best ways to buy a home with 0% down. So the two major ways to buy a home using 0% down, one of them is a VA loan. I made a couple videos on that. You can go check them out after this video, obviously. In my mortgage playlist, it'll say VA right on it. And so if you wanna know more about that, you can go use those. But one of the major requirements for a VA loan is that you have to be a veteran in order to use one. Now the other loan, and is the one that we're going to be talking about here, is called a USDA Rural Development Loan. Rural development, you don't have to be a veteran, but you do have to have other specific requirements, which is what we'll go over in this video. And so I'll walk you through exactly what you need to do to meet those requirements. Also, as a slight side note, I'm going to refer to it as an RD loan going forward instead of saying USDA Rural Development every time I need to say USDA Rural Development. So first, what is an RD loan and what are the purpose of an RD loan? An RD loan is a federally backed loan provided by the United States Agriculture and Rural Development. They're specifically for people who are very low to moderate income. We'll talk about that more in just a second. And they're there to provide safe and adequate housing for primary residences. Again, we'll talk about that in a little bit too, because there's a couple nuances to that I want to talk through. So what are the actual bits that are important to you? Well, an RD loan is a 30-year fixed interest rate mortgage only, meaning there's no 10 or 15 or 20-year mortgage. It has to be 30-year. And it's a fixed interest rate, meaning the interest rate doesn't change for the life of the 30-year loan. Now you can refinance, or obviously if you sell or you get a new mortgage, that would erase your current RD loan. But if you stick with your RD loan, it'll be a fixed interest rate for the entire life of the loan. Now, one of the other important things is that the R in RD is rural, meaning that the home that you're buying has to meet certain geographic guidelines. There will be a link in the description down below directing you to RD's website so you can see by property address if that property meets the rural guidelines. But basically it means that it has to be a rural property, meaning it can't be in like a city center. Even if it's not a big city, it has to be sort of on the outskirts or the suburbs or the rural areas. And so again, if you find properties that you think might meet that requirement, you can go on their website, again, link in the description down below, and look up that property address and it'll tell you if it's eligible for that program. And now, as I said earlier, it's for primary residence borrowers, meaning that you have to live in the property. It can't be a second home and it can't be an investment property. And it has to be a single family home, meaning a one family home. It can't be a duplex, a 2 to 4 unit, a 3 unit. It has to be made for one family, so a traditional home. Now going back to the investment properties, one thing that you can do with it if you are looking to buy a rental property with a RD loan, again, they're not set up for that, is you buy it as your primary residence, live in it for a little while, do any repairs or any upgrades that you want to do. Then when you're ready to rent it, you could move out and either buy another home for yourself and rent that one, or you can rent that out and move wherever you want. And as I said, this isn't really a loan type that is used to get you to start your rental empire, but it is a great way to get into a house for really cheap. Now, a huge advantage to getting an RD loan over like a conventional or an FHA loan is that the interest rates are the same across the board. Meaning on a conventional or FHA loan, the lower your credit score goes, the higher your interest rate is. On an RD loan, that's not the case. You can have a lower credit score and still get a very good interest rate. Now, as the title says, and as I've said several times throughout the video, one of the major advantages is that you don't have to have a down payment to get an RD loan. But a down payment doesn't mean zero costs. So let me walk you through that, and then I'm gonna go through the tips that'll help you get these costs down to zero. So with every mortgage, there are things called closing costs. These are the costs for your lender, your title company, and your attorney to do your mortgage. It's to do the paperwork, and it's to file title insurance to make sure that you're getting a home free and clear without any additional liens aside from your mortgage. Meaning that someone can't come back, or a previous owner can't come back later on and say that you owe them money now that you're a new owner. This makes sure that you have what's called a clear title to make sure that none of that is out there and that you're actually the real owner of the home. So on a conventional or FHA mortgage, you would have to have 3 to 5% down, plus you have closing costs. On an RD loan, you can put 0% down, but you still have the closing costs. Again, we'll go over the tips in just a second. Now, those closing costs can be between anywhere between 2 and 6% of the purchase price of the home. And so, for example, on a $250,000 house, you could expect between $5,000 and $15,000 in closing costs. This is obviously a big range, so it's important to shop multiple lenders. This will allow you to compare the closing costs between lenders, but also see what their interest rates are. Because some lenders will have really low interest rate but high closing costs. Some will have a higher interest rate but low closing costs. And this is a great way to compare interest rate and cost to do the mortgage. It's important to have both of those when figuring out whether or not you're getting a good deal. And comment down below, would you like to see a separate video on how to shop for a mortgage lender or how to compare deals between mortgage lenders? Let me know in the comments down below. Now, this next point's really important because it's one of the biggest downsides to getting an RD loan. And that's an RD loan charges a 1% upfront fee that you either have to pay at closing or you have to roll it into the mortgage. So on a $250,000 loan, you would be rolling in an extra $2,000. Again, it's over 30 years, so it's not going to increase your payment that much, but it's still a fee to you, so you have to know about it, and you have to factor that into your decision making over getting like a rural or a FHA or a conventional mortgage. And now the other fee that they charge up front, or it's actually built into your monthly payment, is a 0.35% fee. Again, it's built into your monthly payment. So on a $250,000 loan, you times that by 0.0035 and then divide it by 12, and that would be $72 a month extra added to your monthly payment. It's very similar to a conventional or FHA, what they call private mortgage insurance or PMI. You may have heard of it if you've been shopping for mortgages for a while. It's RD's version of that. Now, on conventional and FHA, again, you're gonna have those. On conventional, if you put 20% down, you won't have that. Now, as far as credit requirements go, this is one of the main things that disqualifies someone from a mortgage. Either they don't have good enough credit or they don't have enough credit. Again, I made a couple videos on these. It'll be linked somewhere up there, I think. You can go check those out to see. I have one on like how to go from zero credit to good credit and how to go from bad credit to good credit. So check those out if you're interested in that. Otherwise, for an RD loan, RD, one of the major advantages with them is they don't actually have a credit score limit, meaning you could have bad credit and still get an RD loan. The only thing is that your lender will have a credit requirement. Generally, it's going to be between 620 and 640 minimum. And so again, this is where it's important to shop for different lenders because you might get rejected by one lender because you don't meet their credit requirement. But another lender might be able to approve you because they have a different credit requirement. It can go down to about 550 is the lowest I've seen it. Some lenders could go lower than that though. And so don't get discouraged if you get rejected by another lender. Call another lender. When they're pulling your credit, as long as it's within 2 weeks, it won't impact your credit score further because it'll look like you're shopping for a mortgage. And if you have a zero credit score, a truly zero credit score, you can still get an RD loan. You'll just have to have 12 months proof of rent history and 12 months proof of one alternative credit history line, meaning something that doesn't report on your credit report. So it would be like car insurance, cell phone bill, utility bills. A 12-month history of those can be added on, and that can help you qualify for an RD loan. And if you don't have 12-month rental history, you could present a 12-month history of 3 of the things I just mentioned: car loan, utility bills, insurance bills, basically anything that doesn't typically report on your credit report, but you pay them every month. Now, this is where we get nerdy and we get into the weeds a little bit, but this is one of the best sections to help you figure out how much house you can afford, because what the lender calculates and what you can actually afford are 2 different things. And so that's calculated by your debt to income ratio, meaning the amount of your income going towards debt each month. Let me give you an example. Let's say you make $3,000 a month pre-tax, meaning before you pay taxes. On an RD loan, you can qualify for up to 45% of that income, or $1,350 a month, going towards all of your debt, any debt that's reported on your credit report. Not things like food or utilities or anything like that. It's only like credit cards, car loans, other mortgages, student loans, things that actually report every month on your credit report. You couldn't go over $1,350 per month. But remember what I said, pre-tax, meaning you still have to pay tax on that $3,000. So the 45% that you get qualified for is actually probably more like 55 or 60%, which means that you're buying too much home, because again, it doesn't take into account like saving for retirement, emergency funds, buying food or water, or having a social life. And so a good rule is to not buy a home over 25 to 35% of your take-home pay, so the net pay on your pay stub, rather than your pre-tax income, which is your top line. And so to figure this out, add up all your debt monthly payments. One of the best ways to do it is pull a free copy of your credit report. Again, in the description down below, I'll have a link to do that. I'm not affiliated in any way. It's through the credit bureau, but you can pull a free copy of your credit report to see exactly what's reporting on your credit report. And that's gonna give you an idea of what you need to calculate for your payment. But what you wanna do is calculate your income, is do, let's say, our $3,000 times 0.35 or 35%, and the difference will be how much mortgage payment you can qualify for. And then you can go on Bankrate or a free mortgage calculator. Again, I'll link one in the description down below just so you can click it. And then you can plug in like different home prices, let's say 200,000 or 250. And that's going to give you an idea of what a home of that cost would cost you per month. So you can take your difference and match it up with the mortgage calculator, and that'll give you a good idea of what you could reasonably afford. Speaking of income, RD loans have a maximum income limit depending on your area, or every area has a different maximum. And it's usually, you can't make over 115% over the median income for the area. So if you're an above average income, there's a good chance that you're not gonna be able to qualify. I'll have a link in the description down below. Again, I try to do that with all my videos, give you guys extra resources. But once you're ready to start looking for a home, you can click that link and look up your county and your state, and it'll tell you the maximum that you can make for an RD loan. That'll give you a good idea before you start talking to anyone, before you get pre-qualified or anything like that. That'll give you a good idea of whether or not you're gonna qualify, and so you could start saving for a down payment if you don't qualify. All right, so let's jump into the 3 tips that are gonna help you save off your closing costs. Remember, as I said earlier, 0 down doesn't mean 0 cost. So these 3 tips are gonna give you the best advantage to not have to pay any money out of pocket. So tip 1 is to ask your realtor to ask for the sellers to pay your closing costs. On an RD loan, your sellers can pay up to 6% of your purchase price. So on our $250,000 example, they could pay up to $15,000 in closing costs. And for our $250,000 example, $15,000 would cover all of your closing costs, so you would have zero out of pocket. Now, a lot of realtors don't like asking the sellers to pay closing costs, and it can be market dependent, meaning hot markets or seller markets, kind of like what we're in at the time of this recording. Sellers can reject that, but it's still important to ask for, because there are ways that you can build it into the cost of the home, or ways that you can make it look like a stronger offer so sellers don't just automatically reject it. So it's still important to ask your realtor to ask for that, or what they think about asking for that, because it's going to help you cover your costs. And now the second way is, and this is very unique to RD, you can't do this with other loan types, and that is to ask your lender to roll in the closing costs on the mortgage. Again, conventional and FHA, you can't do that. You have to pay those out of pocket. On a RD loan, you can have those rolled in through your closing. The only caveat being is that the appraisal has to allow for it. So let's say you're buying the home for $240,000, but it appraises for $250,000. You could roll in up to $10,000 in cost, but you can't go over the appraised value. So if you're buying the home for $240,000 and it appraises for $240,000, then you wouldn't be able to roll in your costs. And as a brief side note, remember that you can combine these three tips. It's not one or the other, or all or nothing. You can combine all three or use little bits. So like your seller could pay 2%, and then you could roll in some of the costs, and then I'll go through the next one here in just a second. So tip 3, and this is kind of the least desirable, but it can be an advantage in a pinch, or if you truly don't have the money, or you don't want to put the money down for the closing costs, this could be an option to look at. And that would be to ask your lender if they can give you a credit on your interest rate, meaning you take a slightly higher interest rate and they pay you, and that can be applied to your closing costs. On the reverse side, you could also pay extra money to have a lower interest rate as well. But that won't help you with your closing costs. That would add to the closing costs. And so you could take like a 1/4 or a 0.5% higher interest rate and cover most or all of your closing costs depending on the cost of your home. Now, I say it's not very desirable for fairly obvious reasons, and that is you have a higher interest rate, which means you're going to have a slightly higher payment. And over a long period of time, you're going to pay more for the home than what you normally would. But you do want to keep in mind that, especially if you're a first-time home buyer, the average person only keeps their home or their mortgage, meaning they end up refinancing, or they sell, or they pay off their mortgage. Most people don't keep their mortgage for over 5 to 7 years. So it starts to make more sense the shorter time that you have your mortgage. Like if you're like, oh, this is a starter home, I don't plan on being here for more than 5 years, it might make more sense to take a slightly higher interest rate and not pay closing costs out of pocket. Or you could plan on like, I'm gonna have the mortgage for a couple years, see what the interest rates do. If they come down, then I could just refi and potentially eliminate your private mortgage insurance and drop your interest rate. Again, it depends on the market at the time, but that could be built into the plan as something that you'd want to talk to your lender about to see if it's a good option for you. And it could get you into the home, again, with zero money out of pocket. And you can factor in things like furniture or emergencies or painting or doing any upgrades, especially if you're a new homeowner. Sometimes it's better to have the money in your savings account or in your checking account rather than giving it to the bank for closing costs. So it could be worth having a slightly higher interest rate so that you can save that money and use it towards other things like moving into the home. And worst case scenario is if you wanted to later on, you could always put a principal payment down to pay down your mortgage if you found that you didn't need that money. All right, guys, I've had my say. Now it's time for you to have yours. Are you looking to buy a home in 2022, or are you still thinking about renting because interest rates and home prices are a little bit higher? If you'd like to see a video on that, or if you have any questions about this video, comment down below. And if you got value out of this video, please consider hitting that like and subscribe button, and we'll see you on the next one.